During the dot-com boom of the early 2000s, CEO pay in publicly traded companies relative to the average worker skyrocketed to an astronomical level. It reached a peak ratio of 395 to 1 in the year 2000, which essentially means that the average CEO was making more in one day than what the average worker was making in an entire year. Now, the reason why that happened during that year was because of how speculative the market was back then, but also because of how popular share-based compensation was becoming. Back then, you could basically just take any generic business and add a .com to it, and you suddenly had a company that could go public at a massive valuation. So these executives of these companies started to take advantage of this. They started to shift their compensation structures towards more stock awards and stock options that would give them the opportunity to participate in this speculative upside in their company shares. But then, as we all know, the dot-com bubble burst and the values of these shares declined significantly. But if we look at that compensation ratio chart again, we can see that it has still remained high in the years following the dot-com crash, perhaps suggesting that corporate executives have learned from the whole saga that they have the ability to get away with these high pay packages without really being challenged. In fact, from 1978 to 2014, CEO pay increased almost 1,000%, while the S&P 500 itself is only up about half of that, and the pay of the average workers over that time is only up 10%. So this is a massive trend that is occurring and is one of the reasons why income inequality in the Western world has been accelerating as well. So what I want to talk about in this video is how this trend has been able to happen and why I think it's important for investors to understand the implications of these pay packages, and then also what this trend says about income inequality overall. So since the 1970s, executive pay packages have dramatically shifted away from just pure salary and bonus towards stock-based compensation, specifically stock-based compensation that is contingent upon hitting certain performance targets, usually associated with a stock price target. Now, there is a key distinction to be made between realized compensation and granted compensation. And as we can see over the years since 2000, the gap between these two has started to widen, with realized compensation becoming much higher, which I actually think is good news because realized compensation is the value that CEOs actually obtain in that year. So anything from base salary, bonuses, and then the two forms of compensation that have really drove the increase, which are stock options and stock awards. So stock options give the CEO the right to buy their company stock at a given strike price, which is usually going to be the share price on the day that they are granted to the CEO. And the whole point of these is to incentivize the CEO to increase the stock price into the future. And these will usually have vesting periods attached to them as well. So realized compensation would just include the value that vested during that specific year, the value the CEO is entitled to receive and they have actually realized. Whereas granted compensation would include an estimate of how much will vest in future years. So granted compensation is more of a forward-looking measure. And stock awards are similar in that they usually have vesting periods associated with them and require certain performance targets to be met, but these are just stock that is awarded to the executives. It's not an actual option where they have to buy in at the strike price. So stock awards have become more popular over the past 20 years, mainly due to criticism of stock options and how they encourage CEOs to pursue strategies that maximize short-term gains, as opposed to stock awards, which more so encourage them to focus on long-term value. Now, I do think that there is a case to be made for CEOs being paid in accordance with the shareholder value that they create, because after all, that's where the money to pay the CEOs will actually come from. And if you can align their incentives with those of the shareholders, then it should be a win-win for everyone involved. But the fact that CEO pay has increased at about twice the rate as stocks have risen by doesn't really back this up. If it was just a matter of aligning incentives, then we would expect executive compensation to rise at approximately the same rate as the S&P 500. And what we can see is that it's generally correlated with the S&P 500, but clearly it's risen at a much faster rate. So the question is, how has this been allowed to happen? Because ultimately it's the shareholders who own the company and they get to decide on the board of directors, and then the board of directors elects a CEO. And there usually is something on a board called a compensation committee that is responsible for setting the compensation of all the executives, including the CEO. So if shareholders were unhappy with executive pay, they could just vote to reject those pay packages. So this whole idea is often referred to as say on pay, which basically just means shareholders voting to approve or reject executive pay packages. And this was initially introduced as part of the Dodd-Frank Act of 2010. But Say on Pay does have some issues with it. For starters, boards aren't legally obligated to change executive pay packages if their shareholders do happen to vote against it, because these votes are considered more advisory votes and are considered non-binding. And then also consider who the largest shareholders of the top US companies are. It's usually asset managers like BlackRock, Vanguard, and State Street. And these companies typically operate passively managed funds and they own thousands and thousands of companies. So they don't really have the kinds of incentives in place to engage in the type of activism it would take to change these executive compensation packages and vote against them and try and propose new ones. Now, like I said before, there are compensation committees that are a part of the board of directors that decide on how much executives get paid. And who makes up these compensation committees? Well, it's usually other executives within the company. So these other executives probably have similar pay packages in place. Maybe they aren't quite as high as what the CEO is getting, but they benefit from this whole system as well. So they're probably more likely to see these high pay structures as justified. But again, the argument in favor of this is that they're tying compensation to the performance of the company. And if the stock price of a company is going up, then it's likely that the company is doing well. However, stock prices can rise for a variety of reasons, and many of those reasons have nothing to do with the performance of the CEO. Take, for example, Cleveland-Cliffs, which is a $6 billion North American steel company. Back in 2021, steel prices went up a lot because the economy was just starting to open back up after the lockdowns, and this increased demand for construction. Also, with low interest rates that we still had at the time, construction activity was booming, and there was still some supply chain disruptions that were occurring in the steel industry. So steel was more scarce at the time. So 2021 was an amazing year for Cleveland-Cliffs. They reported over $4 billion in operating income versus what they had, say, last year, where they just had $600 million in operating income. So the CEO's pay in the year 2021 was $24 million in total, which was $14 million in bonuses and $7 million in stock awards, versus the year before that, which wasn't as good a year for them, where it was $17 million in total compensation with an $11 million bonus and $4 million in stock awards. Now, clearly, the CEO had nothing to do with the company's performance in 2021. It was purely because steel prices went up a lot, but he still saw a drastic increase in his compensation. So things like this happen all the time in commodity-based industries. It happens in the oil industry as well, where when oil prices go up for whatever reason, the executives of oil companies start to get paid a lot more. But don't think that this kind of thing is just limited to commodity-based industries. There's plenty of examples from other industries where executives are essentially fleecing the companies that they are supposed to serve. One recent example of this is with a company called Plug Power, which is a company that develops hydrogen fuel cell technology, which is a type of renewable energy that can be used in products like forklifts and electric vehicles. So Plug Power surged in 2020 going into early 2021, going from $4 per share to over $60 per share, mainly because investors were starting to become very bullish on anything having to do with green energy and electric vehicles at that time. So their CEO made a crap ton of money in 2021. He made over $50 million in granted compensation, and almost all of that was from option awards that were granted under a new compensation plan that they had just created for him during that year. And since the average worker of that company was only earning about $57,000 per year, this represented a CEO to worker compensation ratio of 916 to 1. And for a company that only did $500 million in revenue that year and had negative $400 million in operating income, this was obviously an absurd pay package that upset some of the investors, especially considering how the stock tanked after that and is now approaching penny stock territory. Remember, the whole argument in favor of this kind of compensation package is that it incentivizes management to act in the best interests of their shareholders. Now, the best place to go to get information on executive pay for a company is the 14A form on the SEC website. All US public companies have to file this form once per year. If you just go to an SEC page of any company and search for it in the list of filings that they have, then you'll see this form and it will usually have a executive compensation section within it. So this is the 2021 form for Plug Power, and they did point out that things weren't quite as bad as they seemed at first here. For starters, these option awards that were granted to the CEO during this year could only be exercised if the stock price remained high, which it ultimately didn't. It actually went down significantly in the years that passed. And if we go to note 20 of their financials, we can see that during the year in 2021, they created this special comp plan for the CEO, and it would last for 3 years. And if the stock price exceeded levels of 35, 50, 65, 80, and $100 per share for any 30-day period after at least 1 year had passed, then he would be awarded the ability to exercise a portion of those stock options. Now, the accounting standards do require you to estimate the fair value of those option awards in the year that they are granted, even if they aren't actually exercisable yet. And you have to include that estimation as part of the total compensation amount when reporting the CEO's pay for that year. And this estimation obviously has a lot of uncertainty because you don't know what future stock prices are going to be for your company, which is kind of what everything is based on. So this causes this massive headline number of $52 million in granted compensation, whereas the actual realized compensation was much lower. It was only $2 million for that year. But keep in mind, these option awards are just based on hitting certain stock price targets, and they start to vest after just 1 year. They're not based on actual fundamental indicators like earnings, revenue, or free cash flow. It's just purely based on hitting stock price targets. And stock prices can go up for a variety of reasons. As we've already established, sometimes they go up for reasons that have nothing to do with the performance of the CEO, and the EV and renewable energy space at the time was proving to be particularly speculative, with many companies being valued at insane multiples that were not actually profitable yet. So I think what happened with Plug Power is that their executives were just shocked at how fast their company's stock price had shot up from this speculative boom that was happening back then. So they created this pay package that would reward them handsomely if that were to continue. So should executives have the ability to extract the value that comes from short-term price fluctuations that just happen to work in their favor? Personally, I think that is essentially akin to a pump and dump scheme and doesn't really give them the incentives that are promised with share-based compensation, which are supposed to be more long-term in nature. Because instead what these do is incentivize the CEOs to take more short-term risks, things that will bump up the stock price in the short term so that they can hit these high price targets and get awarded their stock options or their stock award. But I also think that investors themselves need to understand this, and they need to not make long-term investments into companies that have shown a history of doing this. Companies where the executives have clearly shown that they have a willingness to extract a disproportionately large share of wealth from the companies that they are supposed to serve. Now, the last thing I want to do is to quickly comment on what this whole trend says about income inequality. I'm sure we all know that income inequality is increasing in the Western world, and it's increasing at a higher rate the higher you go up on the income scale. And this can become a problem for many reasons, but one of the reasons is that it creates this we versus them mentality in society. And it can lead to things like the wealthy individuals having too much political influence so they could lobby for policies that benefit them rather than benefit the general good of society. So personally, I do see this as a pretty big problem, and it's something that I think is worthy of a bit more attention when you're doing your investing going forward, especially if you're investing in smaller cap companies where these things take greater effect. But anyways, guys, that pretty much does it for this video, so I hope you did enjoy it and you found it insightful. If you did, then please leave a like, and if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.